Hey everyone, welcome back to Corporate Decoder, and today we're looking at Eaton Corporation's latest move. And let's just say they've been busy refinancing their financial toolkit, like a seasoned pro upgrading their ride. Before we dive in, if you dig getting the real scoop from these dense corporate filings, make sure you're subscribed. And hey, we've got a cracking Discord community where we break down these things even further. Link in the description below. So what is the big news with Eaton Corporation's recent filing? Well, on the 29th of September 2025, they essentially hit the refresh button on some major borrowing agreements. Think of it like this: they had a couple of credit lines they were using and they decided to tweak them and make some bigger and better ones available. This is a standard move for companies to manage their money and make sure they have access to cash when they need it. The main event here is a new credit agreement worth a cool $3 billion. This is a bump up from their previous revolving credit facility, which was capped at $2.5 billion. Now, what is a revolving credit agreement, you ask? Essentially, it is like a credit card for a business. They can borrow money up to a certain limit, use it, and then pay it back and borrow it again. It's flexible and important for day-to-day operations and unexpected needs. This new agreement also allows them to ask for another $1 billion if needed from existing or new banks, which shows they are planning for growth or potential future expenses. This new $3 billion credit line also comes with a feature that allows them to extend the maturity date by 1 year. This provides them with a bit more breathing room and predictability, something any business executive would appreciate. For the average person, this means the company is securing its financial future for a longer term. If banks agree and everything looks good, financially they can push the repayment deadline further out. Now, because they signed this new bigger credit agreement, they also said goodbye to an older one, a 364-day revolving credit agreement that allowed for $500 million in borrowing. They basically terminated it, which is also noted in the filing. So this is just about getting new money. It is also about streamlining their financial arrangements. It's like tidying up your financial desk, getting rid of old notes that aren't relevant anymore, and making sure you have the most efficient tools on hand. When we look at what's publicly traded for Eaton Corporation, we're talking about their ordinary shares, which trade under the ticker symbol ETN on the New York Stock Exchange. They also have some senior notes outstanding, which are essentially long-term loans they've taken out. Two of these are the 4.450% senior notes due 2030 symbol ETN/30 and the 3.625% senior notes due 2035 symbol ETN/35. Both also listed on the New York Stock Exchange. These notes represent different borrowing tranches with specific interest rates and maturity dates. Seeing these details is important because it paints a picture of how the company finances its operations beyond just what you might see in stock price movements. The essence of this filing item 1.01 is about a material definitive agreement, which essentially means a really important contract that could affect the company's business. In this case, it is that new $3 billion credit agreement. It replaces their old one and comes with increased borrowing capacity and some updated terms. This is all about making sure Eaton has the financial flexibility it needs to operate and grow without being constrained by its credit lines. They are proactively managing their debt structure. Item 1.02 talks about the termination of a material definitive agreement. So just as they re-signing new deals, they also closing out old ones. As mentioned, they terminated the existing 5-year revolving credit facility and also all unused commitments under their 364-day facility. This is a clean sweep, a decisive action to consolidate their financial arrangements. It signals a strategic decision to simplify their debt structure and focus on their new upgraded credit lines. Item 2.03 just points us back to item 1.01. It is basically saying, hey, this new big credit agreement is a direct financial obligation for the company. It's money they've committed to be able to borrow, and that creates an obligation for them to manage that debt responsibly. And then we get to the exhibits. Exhibit 10.1 is the actual revolving credit agreement. This is the nitty-gritty legal document that lays out all the terms and conditions of that $3 billion credit line. While we don't need to read every single word of it to understand the gist, our job here is to distill what it means for the company and its investors. It includes details on who is involved, how much can be borrowed, the interest rates, the fees, and all the covenants or rules that the company must follow. Looking at this filing from a broader perspective, Eaton Corporation is clearly focused on solidifying its financial foundation. They are increasing their borrowing capacity, which can be a sign of confidence in their future prospects, or simply a prudent step to ensure they have ample liquidity. The termination of older agreements suggests a strategic simplification of their financial architecture. In the world of corporate finance, managing your credit lines effectively is as important as managing your product lines. This move indicates they are doing just that. They are making sure they have the financial tools readily available to pursue opportunities and weather any economic storms. The increased credit facility suggests confidence from lenders in Eaton, its ability to manage its debt obligations. This is good news for investors as it implies a stable financial outlook. So what is the verdict on Eaton Corporation's latest financial update? They are showing they are proactive in managing their capital structure by securing a larger, more flexible credit line and tidying up older agreements. This suggests a company that is confident in its future and is ensuring it has the financial resources to support its strategic objectives, whether that's growth acquisitions or simply maintaining strong operational cash flow. The key takeaway is prudent financial management. They aren't just taking on debt, they are strategically arranging it to their advantage. Alright, that is our breakdown of Eaton. Recent filing. What is your take on these financial maneuvers and what do you think they signal for the company? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content. Thanks for watching. See you next time.